Hello guys, welcome to another video of CMA US Part 1 Section A series. In today's video, we are going to discuss about the equity investments. In previous video, we discussed about the investment in debt securities. Now today, we are going to study how the accounting for equity investments shall be done. So let's begin. Okay, cool. Now, first of all, how this problem arisen of this equity securities. So whenever company they had extra cash, what they used to do? The extra cash they used to invest, right? They used to invest. So that investment can be in debt as well as in equity securities, right? Now debt securities we have already studied. Equity securities we are going to cover in this chapter. So when they're investing in equity securities, when they're buying shares of another company, they can be of the public company, they can be of the private companies, and also in some of the companies they can have more than 50% of the ownership. They can have more than 50% of the ownership. So in that case, how the accounting should be done in case of public, private, and when they have more than 50% holding, that means they have influential holdings. So that's why at the year end we have to just understand that why some investments are revalued, but for some investments we recognize the income and no dividend is received, and why for some these particular kind of securities the dividends reduces the investment. The dividend does not increase the investment, or it doesn't result in dividend income. So that's why this particular chapter came into the picture. Moving on. Now, why this concept exists? Why this concept exist in order to understand that when we have three types of investment in case of equity, so that's why different accounting should be used. So companies can invest for different reasons, for short-term capital gain, for long-term gain, and maybe in order to have a control over a business. In order to have a control, they can have more than 50% ownership. They can buy more than 50% of the shares. So that's why companies do the investment. Okay, so what is the reason this topic is there? In order to ensure that the accounting matches with the level of involvement. That means how we do the accounting for more than 50% ownership will not be same as what we will do for less than 50% or maybe for short term and long term. Then in order to prevent income manipulation, that means in order to ensure right amount of net income, right amount of dividends from this investments is being reported in my balance sheet, in my income statements. That's why this is there, in order to ensure realistic reporting. That means whatever is mentioned on my income statement and my balance sheet should actually report the correct values. Moving on. Now, first of all, we need to understand how much we own in a business, and that's how we will do the accounting accordingly. In this case of equity investments, we have to understand the level of influence. What is the level of influence? Don't worry, we'll study in the subsequent slides. Now, when we are talking about the influence, so there are basically three types of influence. What are those three types? One is when we don't have any influence. That means between 0 to 20% ownership I have. That means if a company has total 100 shares, I own 15 shares, then this will be termed as what? This will be termed as no influence. But if suppose I own 30 shares, that means I have 30% ownership, that will be termed as a significant influence. But if I own say 65% of the shares, I hold majority of the shares, in that case this will be termed as a control over that company. Okay, that is what these three levels. So this becomes level 1, this becomes level 2, and this becomes level 3. Three levels of this influence. Now, over here one box is given over here that ownership is only a percentage guidelines. Ownership is only a percentage guidelines. Actual influence matters more. That means there can be a scenario where a company has less than 20% ownership, but they still have significant influence. They can still influence that company through various ways. So just the percentage should not be a criteria in deciding what level of influence do we have on a particular company. Now, coming to the part 1. Part 1, when we have 0 to 20%, 0 to 20%, or I can say less than 20% ownership. In that case, what do we have? In that case, we will have either public company or private company. In case of public company, which accounting method we will use? We will use FVTI, FVTI, fair value through net income. Fair value through net income, FVTNI or FVTI. That means whatever change will be there, whatever change in the market price or maybe the fair value of this particular share will happen in the market, I will directly record on my income statement. What does that mean? Suppose I have 10% shares, 10% shares of Tata. Tata is a public company. Now the 10% shares I have, or maybe say 10 shares I have, 10 shares I have, okay. One share is, say, suppose of 10 rupees. Okay, 10 rupees ka ek share is there, so I have 100 rupees worth share. Now this 10 increased to 15, so what is the value now? This 100 becomes 150, so this 50 will go where? This 50 will go in my income statement directly. Okay, that's what this is saying, fair value through income. Now, so this is technique C. When we will use this? When they are our publicly traded shares. This is a public company. Now technique D, when we will use? In case of private company. Now private company shares, they are not traded on stock market. Private companies shares, they are not traded on the stock market, right? So how do we observe their prices? How do we get to know about their prices? So we will see that what is the market price of those shares in the market. That means I will see how much people are usually paying in the market for those shares. Suppose previously I bought some shares for $100, but now the price has reduced to 80. So what I am seeing that the price has reduced. So this will be recorded as what? This will be recorded as impairment. And this will be recorded what? This will be recorded as my impairment, loss in value of those investment. Okay. Now coming to fair value through income, that is technique C. So what do we do? First of all, we consider the market price in order to understand the fair value. Then we see what is the public company. Okay, that means it has to be done for public company. We have to be sure that when we are using the technique C, FVTI, FVTNI, we can say fair value through net income. FVTNI, that is through public company, then it should have less than 20% of ownership. It should have less than 20% of ownership. So then how we can calculate the fair value, and any changes is reported where? In my income statement. This is not like FVOCI. This is not like FVOCI. What happened in FVOCI when we studied the investment in debt securities? That whatever changes in fair value was there, it was reported in my OCI, in my other comprehensive income. But that is not the case in case of technique C. Now how do we measure the technique C? First of all, what is the step 1? First of all, we record that particular investment at its cost. Then on a measurement date, that means maybe during the year end close, we will see that what is the market value. Suppose at the beginning it was 10, and on subsequent measurement date, that means maybe on year end on 31st December, I saw that the value has increased to 13. So 3 plus 3 is the gain. This will go where? This will go in my income statement as a gain. Then there will be what? Any reporting date valuation. That means later on any valuation date, what I will do? I will compare my market price and my fair value. I will compare my market price and my fair value. Now suppose later on what happens? This 13, it became 15. So there is 2. So this 2 will be recorded where? This will be recorded in my P&L. This will be recorded where? In my P&L. Okay. Now coming to the technique C. Now technique C, in case of technique C, when we have unrealized gains and losses, unrealized gains and losses is only for unsold investments that are not being sold. So it is for unsold investment. So what has happened? That means this has not been sold. So any changes plus or minus in the fair value will be recorded where? Will be recorded in my income statement only as unrealized loss or as unrealized gain. In case of gain will be credit and loss will be debit. Why? Because we know one golden rule of accounting. debit all expenses and losses, credit all incomes and gains. So that's why. And other account will be what? Fair value adjustment. Another account will be what? Fair value adjustment. So this entry is passed by. This entry is passed in order to understand what is the difference, increase or decrease in value, that should be recorded. Why this is called unrealized? This is unrealized because this has not yet been sold. Coming to the technique C, in case of realized gain on losses, that means we have sold the investment, we are selling the investment. So step 1, what is my step 1? What is my step 1? Step 1 is to find out the selling price. Step 1 is to find out my selling price. Then compare the selling price and my purchase price, and whatever is the difference will be recorded on my income statement. Whatever will be the difference will be recorded on my income statement. Then how to calculate? Now when the investment is eventually sold, first of all identify the selling price, detect the original cost, report in the income statement. We have already seen. And one important key rule, that is sale price minus original cost will give you realized gain and loss, and this is reported fully in income statement. So there are no need to reverse prior unrealized gains that were already recognized in the previous periods. The cumulative effect is captured in the realized gain calculation. So that means if there is any unrealized gain, that means suppose this investment is being sold in year 3 and in year 1 and year 2 there has been any changes in the value. So any changes in the value would have been recognized as a unrealized gain and losses. So now at this time what we need to do, we don't need to reverse those prior periods unrealized gains and losses which we have recorded over here. Okay, which we have recorded over here. Nothing has to be recorded. Nothing has to be reversed off. Okay. Now what is the journal entry? Journal entry during the sale, cash will be debited because cash will be coming in, and whatever we are giving off investment in equity securities, that has to be credited. Then any difference, gain on sale of investment has to be credited. Why? Because gain is always credited and loss is being what? Loss is always debited. So in case if it would have been loss, so here would have been a loss entry. Okay. Moving on, one example is given over here of unrealized gain. So now suppose the original cost was 1000, year end value of an investment was 1300. So this 300 is my unrealized gain. Why? Because this is unsold, this is not being sold, and where this 300 will go, this unrealized gain will go in my income statement. This unrealized gain will directly be reported in my income statement. Now one more is given over here. Now suppose year 1 when we acquired, this 2000 was there. Now next year, year 2, the fair value was 2500. The increase in 500 goes to the income statement. In year 3 this has been sold. So this is what? 2800. What was the purchase price? 2000. And what is the selling price? 2800. So iska difference is what? 800. The difference of these two is what? 800. This 800 will be recorded as what? Gain recognized over the life of the investment total, but no reversal of the prior unrealized gain is needed. No reversal is needed. Okay. Now a special case, in case of trading securities. What are trading securities? Do we remember that in case of debentures also, in case of debt securities also, we had trading securities, right? We had trading securities. So what are trading securities? That is there only for making profits. That is for actively bought and actively sold in short term. That is what is trading securities. Now which accounting technique is used? That the same, FVTNI. And one important thing to remember guys, that for these trading securities, where it will be reported on my statement of cash flow, where it will be reported in my statement of cash flow, my operating activity. It will be reported in my operating activity and not in my investing activity. Remember guys, this point is mentioned only, that for trading securities, equity trading securities, guys, always remember, equity trading securities will be reported where? in my operating activities of my cash flow, but never in my investing activity of my cash flow. Why? In investing activities, we record those that is being held for long term purpose, and this trading security, this is a short term investment. This is a short term investment. That's why we don't record it as a part of my investing activity. Now, next we have technique D, cost less impairment. When do we use that? First of all, we see what is the market price. First of all, we see what is the market price. So usually this is for private limited company, so there will not be any market price, and also it is used for those companies where we have less than 20% ownership, Now, what is the measurement rule? What is the measurement rule for technique D? First of all, we need to do what? We need to revalue it. We need to do what? We need not to revalue it. First of all, no need of revaluation to its fair value. What we simply do? We calculate the purchase price. Okay. Now, that's how we measure it. Then, when to adjust? When the impairment occurs or there is any change in the observable price changes. That means there is a clear evidence that investment's value has declined significantly, so a loss must be recognized. And observable price change, what happens in case of observable price change? So if a recent transaction involving similar shares provides evidence of a new value, the carrying amount is adjusted accordingly. That means if I see there is a similar kind of investment in the market, which has been the similar kind of shares which is being bought or maybe sold at a lower price, that is showing that there is impairment and there is a change in price, and that's how we are going to do the adjustment. What does impairment means, guys? What does impairment means? Okay, now, sorry guys. So what is the impairment means? Impairment means what? There is a significant decline in value. This word is highlighted. The value of the investment has declined significantly. There is a lot of reduction in the value of that particular investment. Now, so first of all, what is the journal entry for impairment? What is the journal entry for the impairment? Impairment loss debit and credit investment in the shares. Impairment loss debit and credit investment in shares, and this is generally not reversed. This entry is not reversed. Once impairment is recorded, it is not reversed off. Then coming to the technique D, in case of observable price changes. First of all, over here we saw that when to adjust that. First is the impairment and second is the observable changes. Impairment we have already discussed. Impairment means what? Significant decline in the value. And how do we record impairment? This is the journal entry. This is the impairment loss and credit investment in shares. Impairment loss is recorded where? In my income statement. And investment in share means what? I am reducing my asset. Now, in second case, when we have the price adjustment is when case of observable price change. So how do we find out the observable price change? So first of all, this is for private company. Why? Because for public companies we have the fair value through net income. So what do? First of all, we find a recent deal, then we check the relevance. That means we assess that whether this particular deal which is happening is related to how my equity security is, like is it of same nature, is it in the same industry, okay, and then if there is any changes in the value, we adjust the carrying amount accordingly, and gain and loss is reported where? In my income statement. Now over here one technique is given. Over here is 5,000 is the original cost, 4,000 is the recoverable value. So what is my impairment loss? Impairment loss is my 1,000. Okay. Now what is the technique D? One example again is given over here. So what is there? An investor holds a private company share which amount is 8,000. Now there is a subsequent third party purchases block of shares in the same company at a price that implies at a value of 9,200 for the investor's holding. That means we already had some shares for 8,000 worth, but a third party purchased some similar kind of shares in the same company for 9,200. So this is what? An observable price change. And how do we record it? We will increase the value of my investment by 1,200, and the remaining 1,200 will be recorded on my income statement as my gain on investment. Then this upward adjustment is permitted under method 4 only when supported by an observable transaction, not based on estimates alone. Matlab means if there is only estimates, if it is estimated that price is gonna be up or maybe it has increased to this much, then estimates we are not gonna do what? Use in order to record a increase in value. We need to record what? We need to record a observable transaction. We need to do what? We need to record a observable transaction. Now one special rule for preferred stock. What is the special rule for preferred stock? What happens? That is, suppose for preferred stock, first of all, what is preferred stock? They get preference over the dividends. That means whatever dividends will be declared in the company, so first of all dividends has to be paid to them. Then during the time of liquidation, when the company is coming to an end, it is selling off its shares and repaying its debts and everything. So before the common stockholders, before the common stock, these preferred stocks will be paid first, but they don't have any voting rights in the company. That means usually shareholders in a company, they have the right to elect the board of directors, who will carry out the operations at the company, who will select the management and everything. So these preferred stockholders, they don't have any voting rights. Then preferred stock is always treated as no influence investment. That means it is always treated that they don't have any influence. Okay, they don't have any influence. Then which technique is never applied? First of all, this equity method of accounting is never used in this case. In the case of preferred stock, if we have more than 50% ownership, we will never use the equity method of the accounting. Only FVTNI and impairment method, that means technique C and technique D, will only be used. I'll grab some water, guys. Now coming to the dividend accounting and equity method. Now first comes the dividend accounting. When you have less than 20% of the ownership, this is recognized as income in the period received. And what will happen is no stock with dividend, and whenever we have stock dividend and stock split, no income is recognized. Only the number of shares that has been increased, that will be recorded. Then coming to the liquidating dividends, then when we have the liquidating dividends, that is termed as a return of capital. What is liquidating dividends? We'll study in the subsequent slide, but just for your basic understanding, whenever dividends is more than the net income, whenever dividends that is being paid to you is more than what the company has earned, that will be termed as what? That will be termed as liquidating dividends. Okay, now coming to this cash dividends. Now coming to the cash dividends, what happens in case of this? In case of cash dividends, so there are basically two types of dividends. One is cash dividends, one is stock dividends, then there is liquidating dividends. Three types of dividends to be precise. Okay, stock dividend, cash dividend and liquidating dividends. Cash dividends means what? First of all, what is dividend? Whenever people invest money in company shares, they will get some return on it. So the amount of money they get in return, or maybe from net income, whatever they get, what is it termed as? It is termed as cash dividends. Okay, it is termed as what? It is termed as cash dividends. Okay, now when it is termed as cash dividends, that means it has no significant influence. It has no significant influence, and it is directly recognized as income in the income statement. It is directly recognized as the income in the income statement. Now, first journal entry is what? First journal entry is given the of dividend declared. First journal entry is given of dividend declared when the company declares the dividend which is not yet received. So what is the journal entry we pass? We will debit the dividend receivable and we will credit the dividend income, which will go in my income statement. And when we actually receive the cash for that dividend declared, the cash is coming in, we will debit the cash and we will credit the dividend receivable. So the investment account remains unchanged. Investment account remains unchanged. Only income is recorded. Only income is recorded. Then coming to the type 2. What is the type 2? Type 2 is stock dividend and stock splits. So what is happening? The number of shares is increasing and the number of shares will increase. There will be no change in the value. Then there will be no change in the income. There will be no change in the income. Then there will be journal entry which will be recorded, but the per unit cost of the shares will decrease. The per unit cost of shares will increase. So what happens? Instead of giving cash as dividends, the companies, they give more dividends to the shareholders, or they can say that we will have a stock split of 1/2. That means if you have one share, that will be split into two now. So that is what is happening in stock dividend. So under stock dividend or stock split, what happens? First of all, number of shares, they increase. There is no change in the value, total value of the shares. Why? Because you are just given additional shares. You are not giving any money to the company in order to buy those shares. Then no income is recorded. Why? Because you are not getting any money for that. Only the number of shares is increasing and your journal entry will be passed. And there will be no impact on your P&L. No entry will be passed in your P&L for that. No profit and loss impact. Okay guys. Now only the number of shares held, it increases. Only the number of shares held, it increases. The cost per share is recalculated lower per share. I'll take one example. Suppose you had 10 shares of 10 each. 10 shares of 10 each. You had total 100 shares. Now suppose there is a stock split of 1/2. Stock split of 1/2. So this 10 shares became 20, but the value of these shares will be 100 only or not. This value will not be changed. So now the value of each share will be how much? 5. The value of each share previously was 10. Now it is 5. It has been decreased. Okay guys. Now coming to the type 3, in case of liquidating dividends. Liquidating dividends is termed as what? As return of capital. Liquidating dividends is termed as what? As return of capital. So what happens? It happens that first you receive the dividend. Then you liquidate the portion. you liquidate the portion of that dividend and then you recognize the gain. What does that mean? What does that mean? Let's see a journal entry. First of all what happens? That you will get the cash and then you will record a dividend income. And how will you record the liquidating portion? You will debit the cash dividend receivable and credit the investment in securities. Why? Because it is reducing your investment account. Liquidating dividend happens that way. We have one example, we have one or two examples ahead with which it will be more clear. Just to understand guys, we have the two journal entries. First of all, one is for portions from retained earnings that will be recorded as a dividend income, and another is the return of capital. So return of capital will go where? In your investment account. So it is not the income, it is not the income. Now liquidating dividend, what is the worked example for liquidating a dividend? So first of all what is given? That your investment amount is given. What is the total dividend received? That is given. Now investment is 500, total dividend is 1000. This 1000 is split in what way? 300 goes to the income and 700 goes to the liquidating portion. 300 comes from your net income and 700 will liquidate. So the 300 will be recorded as a dividend income, and the 700, the liquidating one, this will do what? This will reduce your income. This will reduce your investments, but your investment is only of 500. Out of this 700, your investment will be fully repaid of 500, and this additional 200 will be what? This will be gain. This will be your gain. Okay, so how much income will be? 300 will be the income and 200 will be my gain. Remaining 500 will be there reducing my investment. Okay, that's how liquidating dividend works, how we will record it. Now coming to the another part, when we have the significant influence. Significant influence means what? We have the ownership between 20% to 50%, and we use what? We will use the equity method of accounting. So what happens in the case of equity method? First of all, in the case of equity method, whatever percentage of income, percentage of net income you own. Suppose I have 35% ownership in a company and a company made $100. So 100 is my net income. Net income is 100. So iska 35%. That means 35 will go where? This 35 will go where? This 35 will go where? This 35 will be recorded where? This 35 sorry guys, yeah, this 35 will be my net income. That will increase my investment. Okay, so that is how the equity method works. And now suppose the company declared $100 of dividend for all the shareholders. So of this 100, 35% I will receive as my dividends. So now suppose this will what? This will reduce my investment by $35 and this will increase my investment by $35. I'm just giving you an example. I think we have few examples ahead that will be making it more easier for us. Okay, we don't have any examples. I will take just one example to make it more easier for you guys. Just a second. Now I'll take one example. Now suppose I have an investment in a company. Of 1000 rupees. This is my equity security. Now in year 1, that company's net income is say $100, and this much I have 10%, not 10%, I can't take 10%. Now suppose I have say 25% ownership. and in year 1 the company makes $100 as the net income. So this $100 ka 25%, 25 will be added in my investment, and in the same year the company declared dividends of say 50 rupees. So this 50 ka 25%, that means 12.5, will reduce my investments amount. So if I take my investment, this 1000, 25 will be added and 12.5 will be subtracted. So what will be the value of my investment? 1012.5. That is what the equity method is, that you increase it by the proportionate percentage of proportionate percentage of ownership you have, and you reduce it by the percentage proportionate of dividends you receive. Okay, so how did we calculate this 25 and 12.5? Whatever was the net income, whatever was the dividends, multiplied by the percentage of ownership I have. Now, what are the indicators of significant influence? What are the indicators? One is the board representation, second is the policy participation, third is the intercompany transactions, fourth is the shared management, fifth is the technology dependence. That means when do you have a significant influence? That means you have a lot of authority over other company. When you are one of the board members, then you participate in the policy making process of the company. Then you have a lot of intercompany transaction, like the other company is the major customer or maybe a major supplier for you. Okay, then shared management. Shared management means what? Like you and that person has what? Has a same kind of, has a same managers, have the same top level of top level of officers like CFO, CTO, COO are same. Then there is some maybe a lot of technology kind of a dependence, like suppose I have any kind of machinery which is highly used in another company in which I have just 10% of investment. In that case also I can say that I have a significant influence in that company. Now, what is the core idea of the equity method? Now, next idea of the equity method is that we do what? We record the proportionate increase and decrease. Why? Because influence is there. So what do we do? We are recording the profit and loss directly in my investment account. As we have seen in this example, we are directly recording this profit where? In my investment account. Now, initial recognition under the equity method. What is the recognition under equity method? First of all, what do we debit? First of all, what happens when we have the this particular investment? The investment is recorded at cost. We debit the investment in associate and credit the cash. Debit the investment and credit the cash. What is included in the cost? We include the purchase price, we include the transaction cost, and any goodwill that is there which we are paying. So that is not shown separately. Goodwill is not shown separately. Goodwill is not shown separately under the equity method, and neither it is tested for impairment. It is not tested for impairment. It is not tested for impairment. Now, post acquisition changes to the investment. What are the post acquisition changes to the investment? Now suppose number one, first of all what happens that whenever we will have the that example which I have already taken, steps are given over here. First of all, we calculate how much percentage of income do we own. Then if there is any loss, then we record the loss. If there is income, we add it in my investment account. Then whatever dividends we receive, we take the percentage of that and we record it in my investment account. It will not be recorded on my P&L. It will not be recorded in my P&L. Dividends reduce the investment. They are not recognized as income or gain. Any loss, profit or any dividends that we received is recorded where? Is recorded on my investment account. It is not recognized as my gain. Now, coming to the equity method. Now, in case of equity method, what happens? In case of equity method, now Example is given over here. You have the ownership of 30%. Investee's net income is 30%, 10,000. So this 3,000 will increase your investment account. This investment will increase. So what will be the journal entry? Debit investment in associate. You will add this in your investment account and you will credit share of profit of associate. So this entry is made regardless of whether the investee actually declares or pays a dividend. So this entry is made irrespective of the fact whether we receive the dividend or not. So one example is given over here. You have an opening investment of 50,000. The percentage share of income you will have, that you will plus in your investment account. Any dividends received, you will reduce it. So 50,000 plus 6,000, 56,000. Then any dividends that you receive, that will not be recorded in my income statement as my investment income. That will be recorded on my investment account as a dividend, and that will reduce my investment. So how much it will become? 54,000 will be my investment. So the formula, very important guys, please understand what is the closing value of my investment, the opening value of my investment. In that we will add the share of income and we will subtract the dividends received. Now what is the key rule? Income without dividend. So income is recognized even if no dividend is declared. Income is recognized even if no income is declared by the investee. So what is happening? Income without dividend means, that means it cost is the equity method. So income is what? We are following the equity method of accounting. That means we have a significant influence. We have usually more than 50% of the ownership in the company. So whatever income they are making, we are entitled to receive that. Income. So we are not recognizing it in my income statement upfront. We are doing what? We are accruing it. That is why we record the income even without the dividend. Now other important concepts under equity method, that means first of all we do what? We do the preferred dividends adjustment. Whatever net income is there, from that we will deduct the preferred dividends. And if there is a case of a stock dividend or stock split, that is not going to impact the the value of my this portfolio. There is going to be no impact on my value. Then no goodwill has to be recorded on the balance sheet and no impairment has been recorded. And the intercompany transactions between the investor and the investee, that has to be eliminated. That means suppose I have invested in Tata company, I have bought a lot of machineries from Tata worth rupees say 100 crores in a year. That kind of a transaction has to be what? Has to be eliminated. Why? Because it's kind of a intercompany transactions. Me and Tata will become one and the same thing if I have a lot of ownership in Tata. Say suppose I have 60% ownership in Tata and I have bought it from them only. So it's like it's my own company. For example, I'll take another example. I have one shop, suppose say I have one shop in Kormangla and my dad has another shop in Shantinagar. So Kormangla and Shantinagar are very close areas in Bangalore, and like it is shop of the same thing. It is a general merchant shop. My dad and I, we have the partnership. So I own 50% of the company and my dad owns 50% of the company, and we have two outlets in two different locations. If we buy and sell goods among each other, among two stores, will it record as a sale? Will it record as a purchases? No, right? So that is what this is talking about. Now, how do we present it on the financial statement? So first of all, on the financial statement, this will be reported as a non-current asset. And where? Because why non-current asset? Because we are holding it for the long period of time. Then how do we record the investment? Investment is shown at the investment plus profit less any dividend. And in the income statement, any loss or profit we have, so that is typically reported as non-operating profit. It is shown as a separate line below the EBIT. That means earning before income and taxes. Okay, now there is one common exam trap. One exam trap is given over here. Then again, receivable, payables, and intercompany balances. So, any accounts receivable and any accounts payables are not eliminated by the intercompany, and they just need to be do what? They just need to be disclosed separately, as we have seen over here. Yeah, any profits, unrealized profits or transaction must be eliminated in case of intercompany transaction. Unrealized profits over here, unrealized profits has to be what? Has to be eliminated, whereas in this case any receivable and payable is there, that has to be what? That has not to be eliminated. They are not supposed to be eliminated under equity method, but they should be disclosed separately. They should be disclosed separately. Please remember this, guys. This whatever we have studied is the case of unrealized profit. In case of intercompany transaction, unrealized profit work, it must be eliminated. But if we have any receivable and payable, that we need to do what? We need to eliminate. Do not need to eliminate it. Now, disposal of investment under equity method. First of all, we determine the carrying value. Then next we compute the gain or loss. First of all, we determine the carrying value. We compute the gain or loss then. So how do we determine the carrying value? What is there after the opening balance, after doing the adjustments of the income, losses and dividends? Then whatever is the sale price, that we calculate. Then we take the subtract both, and that's what my gain and loss on disposal. That is what my gain and loss on disposal. Now, over here we have been given a summary of dividend accounting and equity method at a glance. So in case of dividend accounting, when we have the cash dividends and when we have the stock dividends. For cash dividends, this will return in our income. Stock dividends, it will no entry will be passed. Then liquidating dividends, it reduces the investment. Significant method, when we have the equity method, that means when we have the greater than 50% of the ownership. Share of income, increase the investment, the percentage of income, net income we own. Then any dividends will reduce the investment. Then any disposal, gain or loss on sale. And goodwill is not shown separately, goodwill is embedded. Okay, so yeah, that's all about this. Moving on to the next topic. How do we record the investment accounting methods? What are the investment accounting methods? First of all, fair value. Whenever there is a change in method, that means previously we were using the fair value method, but suppose my ownership increased. In year 1 I had ownership of 20% in the company, but in year 2 it increased to greater than 20%. Previously, say suppose it was 15%. Next year we purchased more shares. Now I have 35% ownership. In that case, what will happen? I will shift from fair value through net income method to equity method. Okay, that's what we need to do. Now suppose if in year 1 I had 35% shares, but in next year I sold some shares and it became 50%. So I lost the significant influence on that company, and there will be what? There will be a change in the method. So from equity method we will change to the fair value method. Now, what is the method? How can we shift? So first of all, there are specific methods in order to change the methods from fair value to equity and equity method to fair value. Now, in case of fair value to equity method, step 1 is to do what? Step 1 is to find out the percentage of the ownership. That means in order we need to understand to bring the investment to its current value. Then recognize any gain or loss that is there. Then first of all, whatever is there previously, that we need to calculate. We need to bring it to its existing value, to its current fair value. We need to bring it to its current fair value. Then any gain or loss we need to recognize after the revaluation. We are doing what? We are recognizing it at its current value. We are doing what? Revaluing it. Any gain or loss is recorded where? Any gain or loss is recorded there. Then we add any investment, we add new investment in that, and lastly we apply the equity method. So equity method, there is no past adjustment is required, only present and future periods are being affected. No past this thing is recorded, only present and future is being affected. Okay. Now, if we have to change from equity method to fair value, that means my percentage of investment has reduced in a company. So first of all, we adjust for the latest equity income, then we recognize the gain or loss on the sale because we are selling off the investment, then we revalue the remaining shares at its fair value, and then we switch to the fair value through net income method, FVTNI. Then we switch to the fair value through net income method. Now, what is the fair value option? What is the fair value option? Entities may elect the fair value option as an alternative to the equity method. What is the fair value option? First of all, choose fair value instead of equity method. That means companies, they use fair value through net income method rather than using the equity method. They are not using the equity method. So choose fair value method, that means what? Report gains and losses directly on the net income. Whenever we are using the fair value method, so any gain and loss will be directly reported in my income statement, and all the dividends received will be recorded as a income on my income statement. And fair value option must be applied consistently. That means we should apply the fair value method throughout the year. If in year 1 I am using the fair value method, then in all the years from that year onwards we should use the fair value through net income method. So this is given the full chapter summary over here. When we have the no influence, less than 20%, significant influence 20 to 50%, then in case of no influence we generally use what? We can use the fair value method, and cost method can also be used, but only impairment adjustments will be done. Then dividend treatment by method is given. If the fair value method is there, cost method is there, whatever dividend is there, dividends are recognized in P&L, dividends are recognized in P&L. And the equity method, in the case of investment account, what will happen in the case of equity method? It will be reported in the investment account and it will reduce my investment balance. Now, one biggest confusion students make, that why dividends are income in one but not in another. So in equity method, dividends are affecting my investment balance. In case of other method, what is happening? In case of fair value method, it is impacting my P&L, because in this case we have the significant influence. We are like the owners of the company. We have more than 50% ownership. So whatever income I am getting, it should be recorded in my investment account. It should not go in my profit and loss account. It should impact my investment account, so that later on when I am selling off that particular investment, I am able to understand that okay, how much was the worth of money that I invested, what is the net income that I keep on getting from this particular investment, and when I am selling it, I can analyze whether I am making a profit or a loss. So that can be a better explanation. Then we have some memory tricks over here, how to remember this, that less than 20% means what? Use market based valuation. 20 to 50% use ownership logic, you have influence. Then if 20 to 50% means what? Ownership logic, that means you using equity method. Then dividend is not equal to income in case of equity method, and liquidating means what? Capital is equals to back, you are getting back your capital. Now, how this topic is tested in the examination? First of all, identifying the correct methods, what has to be used depending on the percentage of ownership. Then calculating the investment balance, calculating the gain and loss, how to classify the dividends, then ownership when there is a change in the ownership scenarios, that. Then question types to expect, what types of questions to expect. MCQs can be there, calculation based can be there, scenario based question, conceptual questions, all of these can be there. Then Examiner twist. What can be the examiner twist? Ownership percentage can be misleading. Why? Because we need to see the influence case also. How to determine the influence? I have listed out the factors above, that what factors can be there in order to understand that we have a significant influence. Then mix of dividend types, we can have both the types of dividends, ordinary dividends as well as liquidating dividends. Then realized gain versus unrealized gain confusion. In the case of fair value method, when do we have the unrealized gain? When the equity is not being sold. And realized gain will be in what case? Realized gain will be in the case when we are selling off the investment. Then method change in the mid of the question, that means suppose the percentage of ownership has increased or decreased, that can be there. Then preferred stocks can be given in the question, so that also we need to keep in mind that in case of preferred stock, we never use the equity method, we use what? FVTNI method or the cost impairment method. What are the mistakes that we as students make? We can treat the equity method treating equity method dividend as the income, because it has to be recorded where? It has to be recorded in my investment account. Then ignoring the unrealized gain. Then missing impairment in cost method, missing the impairment in the cost method. Then forgetting the goodwill treatment, then missing on the goodwill treatment, that can be there. Then not updating the current carrying value before sale. One mistake we can do is that not updating the correct carrying value in order to calculate the correct profit and loss. These are some of the keywords of which the meaning we should understand and we are able to explain clearly. These are some of the keywords. So one student confusion is that fair value and cost method. In case of fair value and cost method, we do not recognize the investee's earning. In case of equity method, we have already recognized the investee's earning. Then in case of fair value and cost method, the dividend is what? Not reducing my The dividend is what? Is recorded in my income statement. In case of equity method, the dividend is reducing my investment account. Now, one exam thinking tip: first of all, identify the level of influence, how much ownership we have. If we have less than 20% ownership, no significant influence. If we have between 20 to 50%, significant influence. In case of significant influence, equity method. In case of 20% or less than, fair value method. Now, methods are there for comparison or is given over here in the tabular form for us to understand clearly. So guys, before the exam or maybe during the revision phase, whenever we are doing revision of this chapter, I know it can be overwhelming to read a lot of slides, so it's better to start from the bottom slides, like which is the topic that can be tested in the examination, what can be the examiner twist, what are the confusion that we as students can make, and then comparison of the methods over here that we need to understand. Then examiner twist, how it can be. So this unrealized versus realized, mid question method change, preferred stock, everything we have already discussed above, and how to calculate, how to do the accounting for it accordingly, everything we have discussed in the previous slides. Then mistake prevention checklist, select the correct method. Then what will be the income statement impact, how to do the calculation. Then when we are doing the method changes, like this checklist is given over here. We have to be clear with all these things in order to ensure we do not make any mistakes. Then what to do next? We can make a one-page revision sheet. We have to do some MCQs of that, maybe 50. It's recommending 50, but whatever number of MCQs we have with this, those many MCQs we should do for this. And what is the golden rule? This golden rule we need to remember: identify the level of influence. Okay, identify the level of influence and then do the accounting. I hope this chapter is clear to you guys. In case you have any questions, any doubts, please feel free to reach out to us. I hope it's clear to all of you. Thank you so much, guys.